The Benefits of Trading Futures, sponsored by CME Group and Ninja Trader. Traders and investors, you've all heard of oil, gold, and corn. They're known as commodities. But what is the best way to get direct exposure to commodities? That's futures. In today's quick video, I'm going to be speaking with the president of Gramza Capital Management, Dan Gramza, about how futures are the best way to get direct exposure to commodities. Dan, most people know what a commodity is, but not everybody knows that the best way to get direct exposure to a commodity is through futures markets. Can you please explain to the traders and investors out there why futures are the best way to get direct exposure to commodities?
Well, you know something, it's a great question. And where it comes into play is this. The basis of the construction of the futures contract by its nature is based on the spot price. Now, the spot price of a commodity is the price that you would get immediately if you exercised or purchased at that price. You get delivery, you get the commodity itself. That's the spot price. So an example of using that spot price would be crude oil futures. Crude oil futures are based upon the spot price for out of Cushing, Oklahoma, the West Texas Intermediate crude oil spot price. And that's an internationally accepted spot price. So the result is you get the direct exposure to that commodity. Now, let's talk about some challenges that we can also face with other products because we have choices when it comes to getting commodity exposure. So let's just talk about stocks for a minute. Stocks can be a great investment, but when it comes to commodities, you got to deal with a few issues. First, they can be discounted because of the dividend. That can knock the price down a bit. Plus, if you think about a commodity, let's look at gold. If you look at a gold mining stock, it's a tricky bit to find a stock that is directly correlated to the gold. Why? Because most mining stocks are highly diversified. You know, they're into other metals, they're into different operations of the gold process itself, maybe exploration, mining, distribution of the commodity. So the gold market, when it comes to stocks, can be a challenge. And you know, another choice we have, Anthony, is we have ETFs. ETFs, exchange traded funds, are another way to gain exposure to commodities. But there are some challenges. You know, oftentimes they embed futures markets into ETFs because futures give you that direct exposure. But the challenge is that when the futures contracts expire, they get rolled to the next contract. And that can cause some misalignment to the underlying index. Plus, you know, something else I think we should think about is just the overall movement of the stock market has an impact on ETFs and commodities. Let's say the stock market moves down 100 points. Well, it's going to drag down that ETF. It's going to drag down the prices of that stock. So the result is that those stocks and ETF become misaligned with the underlying commodity. So when you're looking at futures markets, you get that direct exposure as opposed to an indirect way to get the exposure through a stock or an ETF. So I think what you want to think about is this. The structural design of the futures market using the spot price representing the cash market, which means you're going to be highly correlated to the cash market, is probably the most pure, direct way to gain exposure to commodities.
Dan, you are absolutely right. Thank you so much for that explanation. To the traders and investors out there, it is the purest way to get direct exposure to commodities, and that's through the futures markets. Dan, thank you so much.
My pleasure to be with you again.
Dan gave a vast set of examples on how traders or investors can get direct exposure to commodities through the futures markets. So if you're a trader or investor looking for direct exposure to commodities, look no further than the futures markets. Thank you very much for watching The Benefits of Futures.